The big fear right now, David, is this silliness over breadth, 5 stocks going up, everything else terrible, and the fear of a drawdown. Tie the two together.
Well, the subject of a drawdown, of course, will bring happiness to Lisa to hear about that. But the idea of a narrowing breadth market is, I think, an important characteristic of the last 6 months. So there's been a relatively few stocks that have driven the market to these pretty much record levels. And the history would suggest that over the next 3 to 6 months, you'll get a larger than average, a deeper than average drawdown. Say, for example, instead of a 4% drawdown over time, over a couple month period, you may likely get an 8% drawdown. That's what history would suggest once there's such a significant narrowing of breadth in the market. However, if you think about where you end the, not just the year, but over that period of time, equity prices likely to be higher. Why is that the case? All of the focus today and your conversations before have been about the announcement of the Fed today and the dot plot and the tapering. All those are important. But the fundamental issue in equities has been this year, you've had a huge spike in commodities. You've had supply chain disruption. You've had difficulty in companies finding and keeping employees. And you've had the variants, the Delta and the Omicron, all these issues, yet profit margins in the United States across every sector are at record high levels. Managements have been very nimble in basically dealing with these issues. And so we look into 2022, earnings up around 8%. Largely, the economy is still growing at a decelerating pace, margins increasing slightly. That is the story for 2022. You have a flat valuation, in my opinion. That's how you get to 5,100, or up roughly 10%, maybe 11% total return when you add in dividend yield.
So, David, just to be clear, I'm not rooting for a downdraft here, but I do think a lot of people have been talking about how things look perilously valued. Your argument is they are not, because you're going to get the ongoing margin, sort of incremental growth in terms of how much they're expanding. What's the down case scenario, just because I want to be in brand here? What's the sense that we're going to get some kind of rate hike or savings accounts that get depleted and the consumers say, no mas, we're not going to accept and give you money and not only pay you enough for more inflation, but then more?
So, Lisa, the disconnect and the discussion with most portfolio managers relates to the situation that fast growing companies that are fast profit profit growth, and high margin companies trade at basically the same valuation as fast growing but negative margins, losing money, or very thin profit margins. Those two groups of stocks is anomalous that they would be trading at roughly the same valuation. To give you a number, roughly sort of 9 times enterprise value to sales. What are we talking about? We're talking about companies with a forecast of, say, 20% revenue growth. Both sides, but some are having 20% margins, others basically companies losing money. And the issue is, as rates go higher, and to be clear, that is the forecast of Goldman Sachs, that 10-year Treasury yields will climb towards around 2% at the end of next year. In that environment, it is exceedingly unlikely that you get the same valuation for these two groups of stocks. And the idea the market is unforgiving if companies which have high revenue growth and all the valuation is dependent on that revenue growth, as compared with companies where there's rapid revenue growth, but there's also high profit margins to work with. That's the central tension in most conversations with fund managers, because so many of the money-losing, loss-making growth stocks are very much in the meme specter, or the sort of glamour stocks in the market that everyone has been so benefited from in the profit over the last couple of years in terms of performance.
David, the obsession now, as you know, is to look forward 12 months. Can we just reflect on the last 12 months briefly? I remember about 12 months ago looking at your original forecast for the S&P 500, which was 4,300. And when that first came out, I think the S&P was in and around 3,500. And we looked at your forecast, looked at JP Morgan's, which was a little bit higher, and everybody sat there and said, come on, this is ridiculous. We're really going to have a year that big. We broke through 4,700 before we got to the end of the year. David, I want to understand from your standpoint, when we play this game each and every year at this time of year, when you look back 12 months, what's been the biggest lesson for you and the team as you speak to clients?
So the biggest lesson, and you were right, at this time last year, our forecast for the S&P 500 at the end of 2021 was 4,300, and we lifted that to 4,700 in August. The biggest surprise has been the resilience, in my opinion, the biggest surprise has been the resilience of corporate margins. And that's been a key driver of why you've had earnings, and it's really been an earnings-led market. I think that's really the most important development. It has not been a valuation expansion story. It's been a earnings-led market. And I look into 2022, Jonathan, and that is the same outlook that we're anticipating, which is earnings climbing around 8%. The other aspect that was surprising to me is all year long, and when you've invited me on as a guest, most of this year, we've been looking and handicapping the probability of a higher corporate tax rate. We were assuming most of this year there would be some legislation passed, some reconciliation legislation passed this year and affecting and headwind to profit growth next year. But now it looks as though whatever legislation may or may not be passed, and I do expect some legislation to be passed, but that tax headwind, tax hike, will not affect company profits until 2023. So basically that extra earnings inures to the investor. That's the other. So profit margins and the lack of an increase in tax legislation, I think, have been the two surprises to me.
David, your distinction is you say just shut up and own them, own a high growth, own a high margin, own a high profit stocks. And there's X number of those as well. Are they under-owned or over-owned right now?
Well, it depends if you want to talk about the hedge fund community or the mutual fund community. So, Tom, that makes a difference.
Please make
in
that
terms of
distinction.
Which clients we're looking at. So if you look at the hedge fund community, the leveraged community, basically owning the leading stocks in the market, that's been persistent for 20 years. We look at this every 90 days and been looking at this since 2001. And that's been pretty much in the last 4 or 5 years, the same stocks, the leading stocks in the market, largest companies in the market, have been dominating their performance and their portfolios. And that's pretty much in similar to the whole index, if you will. If you look and so they're overweight, those stocks. And then you look into the mutual fund area, and they're significantly underweight. And here we're looking at large cap core managers, value managers, looking at a different benchmark and growth managers. But in terms of your core mutual fund managers, they're actually underweight those larger stocks, in part because they're such a significant weighting in the market. 5 stocks, 25% of the market.
David, I want to come back to you on multiples. We talked a lot about earnings. It's been the big surprise of this year. You're talking about earnings being the big surprise for next year too, potentially. Let's just sit on multiples for a moment. There's been some confusion around why multiples are so elevated. I want to understand what it is from your perspective. Is it that early recovery where earnings start to deliver upside surprise, beat and raise? That's where Deutsche Bank sit on the idea. Or is it the fact that rates are low? And if it's rates, what does that mean for the Fed and what that means for multiples going forward? Can you give me your view on that right now, David?
So we think about valuation on an absolute metric. If you look at enterprise value to sales, enterprise value to EBITDA, price earnings multiple, any of those metrics, the equity valuations are extremely high. I would say the rationale for the market being reasonably attractive does depend on the extremely low interest rate environment that we have, whether that's corporate bond yields, TIPS, inflation, protected securities, or even nominal treasury yields. In all those interest rate related metrics, equities look reasonably attractive. So, Jonathan, an important construct to think about is that in history, it shows 6 months before a Fed hike, 6 months after a Fed hike. That 1 year period, basically you have multiples flat. In every one of the tightening regimes that you've seen over time, that's been the experience. And so that happens to match up pretty closely with calendar year 22, coincidentally. You're starting now, it's about 6 months before the expected first hike, and 6 months after would, of course, put you at the end of 2022. That's not the forecast for a stable multiple. That's not upon which we make the forecast, but as a result, that's consistent with history. The way we think about it is rates are going higher, risk premium going a bit lower. Why is it a bit lower? Consumer confidence remains high, unemployment falling, and wages are increasing, number one. And number two, the policy uncertainty I referenced earlier about tax hikes, the election for next November. So once that's beyond us, you'll be basically back to a roughly stable valuation, around 20 to 21 times, which is the valuation now, historically high, but still reasonably attractive in a low interest rate environment, even with rates rising.